I'm just going to run through here and then I will open up for a question, okay? Just very how much tax that you pay will depending on whether you are a resident taxpayer or non-resident. And how do they class, like resident for tax purposes is different from immigration. So sometimes people say, I'm not a resident yet. I haven't got my Australian citizen yet. It's different from the immigration. Like if you come to live in Australia and you got permanent resident sort of status, like you're allowed to stay in Australia and you stay more than 6 months, then you can consider to be a resident for Australia tax purposes. And if you are a resident for tax purposes, then you have to declare your income in Australia and outside Australia as well. So sometimes it's not, depending on the client's case. Sometimes this will sort of make a huge difference on their tax, what they have to pay. So we have to be careful on this area of classify them whether they are resident or non-resident. So basically, if they stay in Australia for more than 6 months, then they can consider to be a resident for tax purposes. Then the tax rate is different because they will allow to get that tax threshold. And I'll go into a little bit more detail how we calculate the tax. And they have to disclose all income inside and outside Australia. You will find that I try to repeat things over a couple of times because I want you to get it. So I will sort of try to explain to you in all different ways. So by the end of this webinar, my purpose is like you understand sort of clearly and fully of understand what is the Australian tax systems like. So that's why I'll sort of keep repeating the keyword here. So the more income that you earn, the more tax that you pay. So we all know that. Okay, so if you are a non-resident, then you only have to pay tax on what you earn in Australia. So sometimes if you're having a lot of income overseas, then it's better that you put yourself as a non-resident because in that case you don't have to declare the income that you earn outside Australia. So it depends case by case, okay? And in the ATO website, there's a they have this sort of like a software that you can follow. So if you're not sure whether you're a resident or non-resident, you can go in there and you answer a few questions. Then you can at the end you can determine whether you are a resident or non-resident because this will have a very sort of big effect on your tax, how much tax that you have to pay in Australia. Okay, income. Okay, for income we have 3 types of income. We have personal exertion income. That is like you're using your own labor, like salary and wages. It's what we call is Payg earner. People have to use their personal ability to earn the income. Like you're working and you earn salary and wages. It's called personal exertion income. Or maybe you're receiving commissions or director's fees or bonus or allowance. This is all personal exertion income. And if you are working as an employee, then what happens is that when you start the job, the employer, they will give you a tax file number declaration form to fill in. And in that tax file number declaration form, it will depending on what box that you tick. And if you tick that you are you're going to claim the tax-free threshold, then your tax, because each week, say for example, if the employer pay you $500, then they will look at the table, say $500, how much is the withholding tax they have to take. Then they have to collect that money first and then just pay you, say, $350. So they withhold those tax and then they pay it to the government each quarter, depending on whether they report it monthly or quarterly. So if they report it quarterly, then every 3 months, they will add up all the tax that they collected from all the employee, and then they will pay to the tax office. And at the end of the year, they will give you what we call the Payg payment summary to tell you that how much gross income that you earn, how much Payg withholding tax that they withhold from you. And then what you do as an individual, you take that Payg payment summary plus other income like you earn from interest from the bank or dividends or rent. you add it all up and then you lodge your tax return and you claim all the allowable deduction. So if it works out that you already pay tax too much, then you're going to get a tax refund. But if it works out that you don't pay enough tax, then you have to pay them back. So that's why I'm going to go into a minute at how we calculate the taxable income. And just to give you some, if you are a PAYG earner, the first thing when you start job is you fill up the tax file number declaration form. And you also, if you're working in Australia, you're also entitled to that 9% what we call superannuation contribution by the employer. So when you start the work, they will ask you, where would you like us to pay the super to? And so you can have your own choice. You can pick your own superannuation fund company, and then they can pay the 9% super for you to that account. And that's normally for people that working in Australia as an employee, and that's their entitlement. So that's the personal exertion income. Then you have what we call the property and investment income. That's basically like a passive income that you don't have to use it's not active, like you don't have to use your labor, your hour to work. You pay, for example, if you put the money in the bank account, then you're going to earn interest. And if you earn interest, then you have to pay tax. Or if you invest in shares, you're going to earn dividend. And then but with dividend, it's also got like, in Australia is really, really good system is like, if the company pay you dividend, and if it's a frank dividend, that means like the company already paid the tax, and when they pay you the dividend, they also give you what we call the imputation credit. That means like you don't have to pay the tax on that dividend again. Like they give you the credit. So if your tax rate is below 30%, then virtually you can get some money back. And I know it sounds maybe a little bit complicated for you, but just bear with me. You will get it, okay? Or rent. If you have property and you rent it out to people and you're collecting rent. So what happens is that you're collecting rent after you pay all the expenses to like management fees, council rate, or whatever. The net rent, it's add to your total income, and you have to pay tax on that as well. And annuity and loyalty payment. So that's the second type of income. And then also we have business income. There's people in business, and if they're in business, then we calculate how much net profit that they earn at the end of the year, and minus all the allowable deductions and so forth. Then they have to pay tax on this. But with business, it's also depending on what structure that you're operating on, and I will explain to you, because if you're operating as a sole trader, that means that you use your own name to operate a business. It's a different tax rate. Or if you incorporate as a company, it's 30% tax rate. So a trust, a partnership, it's all working out differently, and I will explain that to you in a minute. And then you have another type of you can say it's income is what we call it's capital gains. So capital gains is like what I just explained to you before, is like, say if you sell your shares, but again, it depending on if you're buying shares as an investor, then if you sell it, then that's a capital gains. But if you're trading your share, that means that you treat it as a business and you buy and sell share all the time, then it's like a business. Then it's a trading profit. Then it's taxed differently. Okay, so you if it's not a capital gains, and if you don't hold more than 12 months, then if you hold more than 12 months, then you're gonna get that 50% discount. So it's different. It depending on the if it's a trading or if it's an investor. But what I'm talking here is assuming that the people that buy shares for investment as an investor, or if you sell your property, investment property, then if you make capital gains, you have to pay capital gains tax. Or business, and see here I put capital gains. If you hold less than 12 months, then you can't get the 50% discount. What I mean by that is that, say if you make 100,000 profit, and if you can't get the 50% discount, then you have to pay the tax on all the 100,000. But if you hold more than 12 months and you can get the 50% discount, then instead of you pay tax on the 100,000, you only pay tax on the 50,000. So that reduces a lot of tax, and that's why it's very important. Like even you hold one more day, more than the 12 months, you can get that 50% discount straight away. So that's why with the client, sometimes if they're asking you questions about that, you have to have this sort of knowledge and sort of let them be aware of this, because sometimes people sort of rush to just want to sell, and they didn't sort of have the right timing, and they might end up paying all the tax, and at the end, whatever the profit that they're supposed to make, they just share with the government. You know what I mean? What a shame. Okay, but you don't have to pay tax on your house, which is good. And another very common thing that people do is that sometimes if you have your house, and because you have to work overseas and then you rent out your house while you're working overseas, you have up to 6 years sort of say if and then you're going to sell your house, because you know how I told you that if you sell your own main resident, you don't have to pay capital gains tax, right? But if you rent it out as an investment property, then you have to pay tax. But for your own resident, they give you like up to the 6 years window opportunity. So say if your own house and you rent it out and then you go overseas and work. So make sure you come back before 6 years and come and stay back again. And then you can go again. You know what I mean? Then you can sort of have that rotation. So and then if you sell, then you don't have to pay the capital gains tax. That's it's all to do with the tax planning. And what I'm explaining to here is very, very sort of like a basics things. I'm not going to go into detail, otherwise I'm going to bore you. Hang on. Let me just close this. Okay, so if you are a company, then company pays 30% tax, and there's no Medicare levy for company, and the company can be resident and non-resident. So if the company is incorporated in Australia and all the management and everyone is in Australia, then that's a resident company in Australia. Or if it's controlled by overseas and all that, then that's non-resident.